You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Mike Swanson from WallStreetWindow.com. Welcome to the show, Mike.
Oh, thanks for having me. It's great to talk with you.
It's very interesting that the U.S. Fed's Janet Yellen has made a huge connection between the U.S. and China economy, saying without a healthy China, the U.S. is going to suck.
Yeah, it's quite remarkable. If you think back to where we were in December, the Fed raised rates by a quarter point, and when they announced that, they said that the economy had, the word they used was normalized, that everything had returned to normal, from meaning that we had returned to the way things were before the disaster of 2008, and, you know, they had to bail out these banks and do quantitative easing, and it was just a mess for people. And the economy really hasn't recovered yet in the United States, where we have sustainable economic growth, growing a middle class and giving people good paying jobs. So she said we'd return to normal and we can expect things to get better. And along with that, she said that the Fed would raise rates 4 times in 2016. Now here we are in 2016, and we've already had 2 Federal Reserve meetings, and they did not raise rates. And now she gave that comment yesterday, which really was a way to say we're not going to be able to raise rates now because the economy in China is doing bad and we're linked to China. There's other things going on overseas too. Now, we've also seen over the past this year, the Bank of Japan engage in a quantitative easing operation, a brand new one, and the European Central Bank do the same thing. They increase theirs. Now, neither one of their stock markets have really responded, and rallied strongly on that news. The Japanese market's actually lower from when it announced it. But what's going on is that these central banks around the world are doing these things, and the Federal Reserve doesn't want to tighten too much more when these people are doing, looser monetary policies. They don't want the dollar to skyrocket and it hurt U.S. exporters. But instead of saying that, and also they have other concerns too. We had a dip in the stock market in January. Whenever the S&P 500 goes below 2,000, the Federal Reserve people start to get worried. And even more scary, there's a bunch of banks in Europe, including Deutsche Bank. Just about all the major European banks took a very big plunge in their stock prices in January and February. And I think that really spooked central banks around the world. It could be the real reason why the ECB did their money print. But there's these things in the shadows, worries out there, and the Fed at this point doesn't want to raise rates, it seems. But instead of just out saying that, they're kind of like making excuses and just blaming it all on China, especially when they are concerned about what's going on here. The economy here has not really grown. The first quarter GDP numbers aren't even expected to be over 1%. So we're not really returning to the normal economic situation that they predicted would happen this year. And by the way, they've made these predictions before, back in 2012 and 2013, and they didn't happen, and they blamed it all on the rest of the world. So there's really, I think, just excuse-making, a desire on the Federal Reserve to say that there's nothing wrong with the things they've done, or no reason that they're not working. It's always just the rest of the world's fault.
Well, how interesting. And I suppose if the rest of the world picked up, the U.S. would take credit for that, though.
Yeah. Well, what's irony, though, is at this point, I think a lot of these central banks are actually seem to be working together and coordinating these policies together. There's been a popular concept that they weren't going to do this, that they would have these, what they were termed currency wars, where they'd be racing each other to blow up each other's currencies or competing to see who can print the most money or so forth. I don't think that's really happened, and maybe it will happen someday. But at this point, it just seems like when the U.S. stock market goes below 2,000, they get worried, and central banks around the world also get concerned, and they try to stabilize things. And someday, I think these type of things aren't going to work anymore. And at this point, we've had a 6-week rally back in the U.S. stock market, back up above 2050 on the S&P 500. It's basically gone straight up, and it's overbought. And if you look at, the way these rallies have traded, really for a year and a half, every time they get in this situation, they basically start to roll over and go right back down to the previous support levels. Now, the support level this year is lower than it was last year because of the nice tumble we had in January. So we're really looking at like 1880 on the S&P 500. Now, it's very easy though. You see the news yesterday, and the market capped up this morning when we're speaking, and people get on TV at least. I don't really think the average person's very excited about the stock market anymore because they're not really making that much money in it. In fact, I would venture that most people are losing money year over year because the market hasn't done anything, and most stocks are down or performing worse. Even with this rally, only 35% of the stocks in the entire NASDAQ have managed to get above the 200 moving averages. The Russell 2000, which is 2,000 stocks, they haven't been able to rally that much either. The rally has really been driven by the Dow and the S&P 500 and big cap stocks that are engaging in share buybacks, whereas most stocks aren't doing that good. It makes it hard for the average person to really be doing well in this market. So there really aren't that many people very excited about the stock market. However, if you watch the television this morning, they're extremely excited because what they tend to do is just focus on the averages. And when you focus only on the averages, they have been up for 6 weeks here. And so you had the news and the gap up. But at this point, if we see some sort of reversal day in those averages, which would mean a day in which they're up pretty good, but then close a little even or even in the red a little bit is even possible, I think that'd be a sign that the top is in. And either way, I really think these are good levels to be selling at and moving money into things that look like they're in a position now to really go up in a sustainable way, not just go up for 6 weeks or hope, well, we've had the 6 weeks, can we get 2 more? I'm more interested in buying things I think go up for a couple years, not just a couple weeks. And we've got those kind of opportunities finally when it comes to commodities in gold and silver in the mining stocks in particular right now.
Yes, and if people think negative interest rates are a good way to go, in Europe, insurance companies, banks, and pension funds are in horrible trouble because nobody can make a return from their investment.
Yeah, that's exactly right. And the thing about it is, it does make it very difficult for people. And how do you invest safely in the financial markets when if you put your money in a money market or in bonds, treasury bonds, you can't make any interest. An answer to that has been, some people have recommended, well, we'll just put it in corporate bonds and get a higher rate of interest, or even more common over the past couple of years, just buy the Dow stocks because they pay dividends. And the rationale is, well, since interest rates are zero, the stocks should be worth anything, the stock market's overvalued on a historical basis. If you look at the cyclically adjusted PE, it's only been at this valuation level 3 times in its entire history. You know, if you look at the chart, we're above the prices of 2007, but the cyclically adjusted PE ratio is much more meaningful. But people rationalize investing in it with the idea that there's nothing else anyone can do because interest rates are 0. Well, the thing is, there are things to do now. There are alternatives, and gold is starting to go up. Gold was at a low around 10.50 or 10.40 an ounce in January, and you know, it's gone up to about 12.70. The gold stocks have gone up about 80%, and these are things that, you know, seem like they're now in a position to go up for years. They were in a bear market from about 2011 to 2015. Cycles change, so there we are. And not only that, but when you have an environment of negative interest rates from many central banks around the world, and at this point, people are starting to wonder, you know, in December, as I said, Janet Yellen and the Fed said we finally are getting things back to normal. Well, if we're not normal by now, 8 years later, oh my gosh, when is it ever going to get to normal? And if it, and is it going to get worse? And they can't even raise rates. I mean, they can't. I mean, you can't have a normal economy with 0 interest rates forever. It's just not healthy. If you can't lend money to people and make some sort of safe, rational interest, it's just not a good situation. Well, the solution for people who want safety is to buy gold at this point. And I'm sure lots of people have been doing it over the years, but now that it's starting to go up, more people will get interested in that. The problem at this moment, as we're talking though, with gold, is the bear market that we had before. It lasted for years. It made gold stocks the worst investment for years, even though this year they're actually the best performing sector in the entire stock market from year to date. They're not talked about on CNBC as a momentum play. You know, you would think it would be the fast money people and Kramer that love momentum. They love to chase. They won't talk about it. And I think the reason why is because it's not popular with people due to that bear market. So many people did lose a lot of money in that bear market in gold and the mining stocks that even though they're up now, we've seen so many rallies fail in the past that it's just, you know, people are still very skeptical and they don't want to get burnt again. And that's understandable. But I think what's going to end up happening is, as we're speaking, we're seeing a pause, a pullback, a consolidation for gold in the mining stocks. Gold right now seems to have support around 1,180 and the 1,200 level, and seem to be building a base around there, above that, and the mining stocks doing the same thing. And if they do that and then break out of the highs set recently in February, then I think you'll see people really get interested in gold. The people who are skeptical will no longer be skeptical, and we'll get an even bigger rally for the rest of the year than what we've already seen. So I think that's the situation. We're kind of in a time where gold is pausing, but the excitement is going to come. And with the stock market, we've had people on TV excited about it, but I think the market will be rolling over sometime soon, and we'll just be heading back down to the lows. And if we end up breaking those lows this year, then it'll really be a lot of selling that comes in.
We'll have more with Mike Swanson right after the break.
Unbelievable harmony, spectacular performance, the ultimate tribute to the Everly Brothers and Simon and Garfunkel. Bird Dog and the Vintage Electric Band coming to Mission, White Rock, West Vancouver. Buy online and save at ontourtickets.com.
Welcome back. We're speaking with Mike Swanson. Mike, what's going to happen with crude prices? We had 5 days of decline, then a pickup. Is it going to be a long, slow slog to see it improve, or will it stay above $40 a barrel on the long run for the rest of the year?
I think we'll end up back down below there for a while. And the reason why is, well, there's two reasons. The first reason is there still is a substantial short position in the oil market by commercial players, which includes Saudi Arabia. And they tend to be right. But I think we got probably the rest of the year to work that off. That doesn't mean oil's going to crash or something, but I just think it's going to take time. And that goes into the second reason, and that is commodities tend to go in a cycle in themselves, in which gold and silver start bull markets first, and then other individual commodities such as, let's say, corn or wheat or hogs or coffee then follow into bull markets. And oil and energy tend to go into bull markets last, sometimes even years after the bull market in gold and silver do it. So, for example, in 2002, gold and silver really started a bull market. They had bottomed in 2000, but it was clear to everyone by 2002 that they were starting a bull market. But oil didn't really start one for over another year. It had been, it made a major low around 1999. So it took about 4 years for it to really get real bullish there. And gold itself, in the mining stocks, they really based out from, let's say, last July to this January before they started their market run. And what that suggests and is what happens is after a big bear market in anything, often you get a period of consolidation or basing and so forth that serves as a prelude to the next bull market. I think that sort of basing phase is what oil is in now. So I don't think we'll really see a new bull market in oil until the end of this year or even next year. So I think there's plenty of time. And when it comes to oil stocks, I wouldn't be surprised if they don't actually fall more, at least the ones in the United States, because they actually are still overvalued from a historical standpoint. Now, oil stocks in some other countries aren't, particularly Russia. They actually have very cheap valuations there, so they may start bull markets this year, way before the American oil companies do. The problem with the American oil companies is that between 2013 and 2014, the U.S. stock market just went straight up at a 45-degree angle without ever pulling back. And the oil stocks went up with it, while at the same time the price of oil really did nothing during those years. It just plateaued. So the oil stocks broke away from the price of oil and just reached a really crazy valuation level, and that's part of the reason why it's not just the price of oil falling that's really hurt them, but it's this crazy bubble level that they topped out at that's trapped so many people in it. And it just takes a lot of time to work these people out of the market before we can get a real bull market in the oil stocks in the United States. So I actually fear that's where the stock market's headed to, also a similar type of situation, where if we break the lows, I think let's say January, and I think we will, then I think the stock market's just gonna, go the way the oil stocks went, or the way the gold stocks went in their last two bear markets. But the big thing about the U.S. stock market, I just think it's dead money either way, because it's so overvalued, and all we're doing, the best case scenario is you just remain stuck in this range for even longer that we were in last year and in the first part of this year.
Mike, where's the smart money going right now?
Well, I mean, where the money's really, the money's really flowing into the gold complex. We've actually seen near record monthly inflows into GLD, the ETF for that. Other than that, what we really have been seeing are just some gyrations up and down without any real meaningful buying. If you take the U.S. stock market, for example, the fourth quarter of last year actually saw one of the biggest record outflows from insider selling ever in the history of the American stock market. And the inflows from insiders hasn't returned. So what we're seeing there is lots of trading and back and forth stuff. But as far as real investing, it's really the gold market. Now, in other commodities, you've seen some, if you want to call it smart money, and you could actually define that in the commodities markets. If you look at the commercials and in the Commitment of Traders reports and what they're buying and selling, well, they took their short position in gold down to a record low in January before this move began, and they've done the same thing actually in many commodities. Some commodities are actually net long in, such as coffee. And so what you basically have are super low short positions, sometimes net long positions, in various commodities, excluding oil and energy, that are almost historic lows, not seen since around the 2000 year, or from 2000 2002. So that's what I think is the real opportunity for people. I tell friends of mine that are in a position where they think, well, I've got my stocks I'm invested in, or I've got my CDs, and they complain that they're not making any money and they don't know what else to do. I mean, my answer is just buy some gold. Put 10% of your money in gold. And my thinking is these people never bought it before, but if they can do that and see that they can make money doing that, then maybe they'll escape out of this mindset that the only choices they have are to be in the U.S. stock market or CDs. I'm speaking of Americans here, of course. Most people in other countries invest in multiple things in multiple countries and are a little more sophisticated, but that's just what things are here.
Mike, thanks a lot for chatting with us.
Yeah, thank you. It's good talking to you as always.
My guest has been Mike Swanson from WallStreetWindow.com. You're listening to HowStreet.com Radio. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. Comments or questions for the show can be emailed to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com Radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com Radio is a production of HowStreet Media Incorporated.